Welcome to the Explainer. So, today we are tackling a really fascinating tension sitting right at the center of the retail world. On the one hand, you have an absolute operational marvel of a company. I mean, it's a business that seems to win in almost any economic environment. But on the other hand, you have a stock valuation that demands absolute unyielding perfection. We are, of course, talking about Costco in August of 2026.
Okay, let's dive right into this. Here is our roadmap for today. We'll start with Costco as a best-in-class retailer, then look at the unstoppable bull case, followed by the bear case of pricey perfection. After that, we'll weigh the upcoming catalysts and risks and wrap it all up with the investor takeaway. So let's kick things off with Section 1, a best-in-class retailer, and that Q3 2026 headline.
Right now, it's a really tough retail environment out there. Most chains are fighting tooth and nail just to scrape by with single-digit gains. But then, there's Costco. In fiscal Q3 2026, their revenue hit a staggering $70.5 billion. That's an 11.6% jump year over year. To put that into perspective, this is their first double-digit top-line growth since way back in 2022. They aren't just growing, they're actually picking up speed.
Which brings us right to Section 2, the unstoppable bull case, and exactly why Costco is accelerating. The first massive growth engine here is their legendary membership moat. And this brilliantly illustrates the absolute loyalty of their customer base. In the US and Canada, their renewal rate sits at a mind-blowing 89.7%. When you zoom out globally, they've got 82.9 million paid members. In just this past quarter alone, those membership fees brought in $1.37 billion. That's up 10.7%. We're talking about pure, high-margin, recurring revenue that competitors literally cannot replicate. Okay, the second engine is this quiet but super effective digital transformation they've been pulling off. E-commerce sales just jumped by 21.5%. But the really fascinating part, and management specifically called this out recently, is their AI search traffic. They're seeing triple-digit growth in AI search, and, it's not just some flashy tech gimmick. It actually boasts the highest conversion rate across any of their channels, so it is driving real, measurable sales. Engine number 3, Costco is the ultimate inflation winner. When prices spike everywhere else, Costco's value proposition just gets incredibly sticky. I mean, we've all seen those crazy long lines at their gas stations, right? And you definitely see it with their private label, Kirkland Signature. Kirkland is expanding like wildfire into totally new territories, moving way beyond regular grocery staples into stuff like protein milk. And get this, even Medicare Advantage insurance. They're giving folks higher quality at lower prices exactly when they need it the most.
So Costco is fundamentally an amazing business. Nobody is really disputing that. But here is the critical question we have to ask ourselves. Can a fundamentally great business actually be a bad investment if you overpay for it? So, is Costco a good investment at its current price?
To figure that out, we need to look at Section 3, the bear case, pricey perfection, and the stark valuation reality.
Now, what's really interesting here is the massive contrast in trailing price to earnings, or PE ratios. The broader S&P 500 average is sitting right around 22x, meaning you pay $22 for every $1 of earnings. Walmart is sitting up there at 42x. But Costco? Costco is trading at a whopping 48x. You are literally paying a 120% premium over the broader market. The market is pricing this wholesale warehouse club much closer to a high-flying tech stock.
And when a stock is priced for absolute perfection, the market expects flawless execution for years to come. We literally just saw this play out in real time. In Q3, Costco beat earnings, they raised revenue, they posted that massive 11.6% growth. It was a stellar report, and what happened the very next day? The stock fell 4%. Why? Because expectations were so sky high that merely being great just wasn't good enough to support that huge premium. We also have to keep in mind that inflation cuts both ways. Sure, high gas prices drive traffic to Costco's pumps, but they also pressure gross margins, mainly because Costco absorbs some of those costs to keep its prices low. If you look at the headline same-store sales growth, it's an awesome 9.8%. But actually, scratch that. Once you strip out gas and currency fluctuations, that growth visibly shrinks down to 6.6%. It's still solid for sure, but it definitely paints a slightly different picture.
That brings us to Section 4, Catalysts and Looming Risks, and what actually moves the stock next.
Let's see how this builds out by weighing the potential upside against the very real risks. On the bullish side, everyone is laser-focused on the September 24th Q4 earnings to see if that digital and membership strength holds up. Then there's the Medicare Advantage expansion. Leveraging that deep member trust to sell insurance could add billions in high-margin recurring revenue. Plus, they still have a massive runway for international growth across Europe and Asia. But on the flip side, valuation compression is a genuine threat. If interest rates stay high, high-multiple growth stocks like Costco could easily see a 10 to 15% correction, even without any actual fundamental weakness in the business. There's also the lingering risk of a broader consumer slowdown hitting even their affluent base. And of course, intense competition. Amazon and Walmart are pouring money into grocery and delivery, an area where Costco is getting better, but still lagging behind. Because of this massive tug-of-war, Wall Street is kind of all over the place. With the current price hovering near $957, the analyst consensus is basically a hold with a target of $1,104. That's about a 17% upside. But look at these extremes. You've got a super bullish target from Bank of America way up at $1,200 and a bearish target from Truist down at $1,011. That wide spread pretty much tells you everything you need to know. There is some serious, passionate conviction on both sides of the fence right now.
Which leads us perfectly into our final segment, Section 5, the investor takeaway, and how we bridge this gap.
So, what does this all mean for you? How do we bridge the gap between a phenomenal company and a super demanding valuation to make a grounded decision? Well, the crucial point is that your strategy really depends on your personal time horizon. If you're a long-term investor looking out 5+ years, Costco is a proven, durable compounder. Management is incredibly disciplined, those growth engines are very real, and just dollar cost averaging into a position makes a ton of sense. However, if you are a shorter-term or highly valuation-sensitive investor, this is definitely more of a wait-and-see scenario. The risk-reward is just a bit lopsided when you're paying for absolute perfection. For those folks, keeping a close eye on the September earnings and waiting for a dip below the $900 mark would offer a much more attractive entry point.
I want to leave you with this final thought that really sums up our explainer today. Costco is a business you want to own, just not at any price. It requires real patience and discipline to let the valuation come to you. So does that current premium make you nervous? Or does their operational excellence make it worth absolutely every penny? Thanks so much for joining me today. I hope this helps you structure your own thoughts on the company. And as always, keep learning.